Long-term bonds and rising inflation expectation analysis. In this video, we'll take an updated look at longer-term TLT technical analysis and possible areas where this correction could turn around. We'll also review a few economic charts to try to make sense of the inflation narrative. Let's go ahead and get right to it. Looking at the TLT weekly view, price is approaching the bottom line of the bearish channel, so next week could be key in determining if the channel holds or if prices will accelerate to the downside. We have horizontal support around 141.80 and additional support around $134, $135 area, which also happens to be the 200-week moving average. RSI is approaching levels where price tends to find short-term support. Looking at Fibonacci retracements in the monthly view, we should be approaching the 50% Fib retracement support at around 145. If that fails, then the next likely stop is the 61.8% retracement at around $138. Now, let's take a look at past corrections and see if there are any similarities. The corrective drawdown in 2009 was about 28% and took about 450 days. In 2012, TLT had a 24% correction that took about 490 days. We had two smaller corrections in 2015 and 2016, but we will skip those since we're focused on the larger ones. We can see that the bullish price move in 2019 is huge in comparison to the previous moves, so we can expect that the correction also will be larger in scope. If we model the previous large correction, a 28% retracement within 450 days puts TLT at around $129, $130 price target by sometime in June of 2021. Coincidentally, the 129, 130 area also happens to be horizontal support. By now, you're probably wondering what the orange line is and what it's doing on a chart. The orange line is the S&P 500 ETF, SPY. If we draw a simple line showing the area of value from a price perspective, we can definitely see that the current S&P 500 price levels are extended from the area of value and that eventually a mean reversion will likely overshoot to the downside before reaching equilibrium again. TLT can be seen as a safe haven during market turmoil. Next, let's look at some economic charts and see if the current data matches the story of sky-high inflation. First up, let's look at unemployment. The official unemployment rate is 6.3% as shown in the blue line. The U6 unemployment rate displayed in the red line is 11.1%. The U6 unemployment rate is more inclusive of people that are marginally employed or underemployed due to economic reasons. Although both metrics are decreasing, the rate of change has dropped significantly. Employment scarring is taking place for young adults entering the workforce, as well as those who struggle to find or retain gainful employment. Higher unemployment and lower wages are not inflationary. In fact, they are deflationary. Next up, we have initial and continued unemployment claims. We can see similar trends to the unemployment rate, but initial unemployment claims have formed a base at around 700 to 800,000 new claims each week. This is not inflationary either. States have different timelines for extended unemployment benefits, but overall, those will start to run out between middle of March to early April unless additional aid is passed. I will leave the link to the unemployment benefits by state map for those interested. Next up, let's look at the credit card debt. Looks like consumers have been aggressively paying down their debts instead of going on spending sprees ever since the pandemic hit. I think the stimulus checks are a big factor here. Paying down debts actually decreases the money supply and is also deflationary. Now let's look at consumer sentiment versus the 5-year forward inflation expectations. Consumer sentiment measures the optimism of consumers about their finances and the economy. Currently, we see inflation expectations shooting higher and sentiment is also edging higher. If consumer sentiment is high, consumers are more likely to spend, which would add validity to the sustained inflation narrative. Watch consumer sentiment closely. If sentiment reverses or stops going up, it will act as an anchor on higher inflation expectations because it creates an environment where consumers will have to pay higher prices for the things they need, like food and energy, and will have less disposable income to spend on something else. Eventually, this puts downward pressure on discretionary goods and services that are priced too high. I'd like to end by saying we are truly in a new normal, and this time the Fed may actually succeed in getting the inflation due to all the fiscal spending and stimulus payments, but inflation does not necessarily equal economic growth. If the 1970s have taught us anything, it's that once inflation gets out of hand, it's not so easy to get it back under control. Watch economic data closely to see if inflation starts to creep up and consumer sentiment continues to go up with it. A liquidity event in the markets like in February of 2020 would likely drive TLT to new all-time highs. Only time will tell if the inflation story prevails. Once again, thank you for watching and see you all in the next video.